So friends, these derivative contracts that buyers and sellers get into, they can do it in markets. And the markets of derivatives are of two kinds. One is the organized exchanges based market, another is the OTC or the over the counter market. So let's discuss what are the similarities and what are the differences between these different kinds of derivative markets. So first we'll discuss about the organized markets or the organized exchanges. So what are these? Let's say you want to buy an option or a contingent claim on a stock XYZ. Okay, the stock price is 35. You think that it will come down to 25 and you want to short the stock with the help of a derivative. Now, the derivative contract, if you go into the organized exchange, will have a fixed contract size. Let's say the contract size for a option which bets on price reduction rather than price gain, this contract size is $10,000, right? The contract size is $10,000 and you have to pay a margin of, let's say 5% or 10% on the contract size to enter into this contract. So you will have to pay how much? If it is 5%, you will have to pay 5% of 10,000, which is $500 to enter into the contract. So the number one property is contracts are fixed. Contracts are fixed. Not only in terms of contract size, it may so happen that the maturity is also fixed. So you want to enter a contract for 1 month, but in the exchange only 3-month ones are available. So this is a 3-month contract, let's say. So you hardly can change it, right? Considering this is not an option which you can sell at any time, you can hardly change it. You cannot change the contract specifications that are given in an exchange, right? So contracts are fixed. Number two is the buyer and seller both put their bets on the exchange. So it's like you and your friend put the money on the table, right? In the football game contract, you and your friend put the money on the table. And here, let's say you gave it to a person who is going to ensure that there is no breach of contract at the end of it. So you and your friend, let's say, gave it to a third friend who is going to ensure that none of you play foul when the game ends. So this is what the exchange is going to do. The buyer and the seller both speculate or both get into the option contract under the supervision of the exchange, right? Under the supervision of the exchange, and the exchange provides credit guarantee. Now, how does exchange provide credit guarantee? One of the things is it does it through this margin, the margin that we spoke about, 5% or 10%. This margin they take from everyone who get into the contracts, and it is based on certain numbers. In such, it is so efficient that in the last 100 years default has not happened. At least when I talk about USA, in the last 100 years default has not yet happened. We'll talk about this in more details when we get into the types of derivatives and how they work. Okay, so this is exchange supervision, exchange credit guarantee based on margin specifically. The third is transparency. Transparency means the exchange authorities, basically are able to see who has got into what contract, who has entered which contract, they can easily track. So transparency also means loss of privacy. Okay, these are the main features. Contracts are fixed. There is exchange supervision, which implies credit guarantee, and there is transparency. These are the three main features of the organized market. Now we will talk about the OTC or the over-the-counter markets. Now, example of derivative contracts which are traded in organized exchanges are futures contracts and option contracts. Now we will talk about the second category of markets, which is the OTC market or the over-the-counter market. Now we will talk about the OTC or the over-the-counter markets. So these markets are basically informal markets where willing participants trade among themselves any kind of derivatives that can be legally created, and they do it through the help of principals who are basically banks who act as dealers of these OTC markets. So let me repeat once again. Generally, these are major banks who are acting as dealers, and these dealers get into various kinds of derivative contracts which come from corporations or other banks, and they do it in such a way that the overall derivative scenario is balanced. That is, let's say somebody has got into a derivative of hedging their risk against the fall of euro. Now the dealers get into such contracts also where this kind of a hedging, that is hedging against fall of euro, is balanced with other contracts which hedge against rise of euro. So the overall balance is maintained in this way. Now the opposing contracts are generally not in exact terms. Let's say somebody is hedging $100 million of euro in this one, that is they are hedging 100 millions against the falling of euro. The opposing derivatives may not be 100 exactly. They may be 10 contracts of 10 million each, or 2 contracts of 50 million each, or maybe 120 million of contracts like this. So, but they are not exact matches, but in time and space, the banks and dealers, through their model expertise and their volume of trades, they are able to balance it overall in a reasonable sense. Now these banks who are acting as dealers are generally members of ISDA. ISDA is basically called the International Swaps and Derivatives Association. They are members of these. Now the features of the OTC markets, let's discuss that. OTC markets, first of all, are informal. This means that these banks or dealers, these banks who are acting as dealers, are not obliged to do so. They are not obliged. So today they are trading in derivatives. Tomorrow if they don't want, they don't trade. Right? That does not mean they back out of entered contracts, but that solely means that whenever they want, they can contract or expand the vertical as per their will. Number 2 is there is less regulation. Less regulation also means more counterparty risk. In case of exchange traded contracts, the organized exchanges were basically giving the credit guarantee. In case of OTC markets, such guarantees do not exist. It is the party itself based on whom you take the contract. Number 3, there is more flexibility. You can create different kinds of contracts, right? The only thing is both the parties have to agree to the contract, then only they can be created and executed. Number 4 is less transparency and more privacy. One caveat one must enter here. After the 2008 financial crisis, the regulations have become tighter and there is more striving towards increased transparency. But nevertheless, compared to the exchange traded markets, there are a lot of exemptions which these OTC markets enjoy. Now, having discussed the different kinds of derivative markets, we would now like to go into the discussion of the different types of derivatives that are traded in the markets. Let's get on with it.